How would you like to increase your borrowing capacity by $50,000 to $100,000 or even more? Hi, I'm Sam Powell.
Hi, and I'm Jaryd Krause, and we are the hosts of Property Pals Australia. And in this podcast episode, we're going to be discussing 3 key ways to increase your borrowing capacity. We're also going to be talking about some examples of how both Sam, myself, friends and family, and people that Sam have worked with to help them increase their borrowing capacity and buy a larger and better asset because they were able to increase their borrowing capacity, and how that set them up for a far better financial future. It's one really good example that you shared around HEC stats and stuff like that. We also have some strategies to increase your hourly rate and earn a higher income as well.
Yeah, so stick around. There's a lot in this episode, and we go on a few different tangents, but overall I think there's a lot of value to take in. We also look at how to minimise and remove your debt, and the second and third order consequences of doing that for your portfolio. So we'll explain that a little bit more. We also look at the repercussions of gambling. Ooh. And it does affect a lot of households in Australia, and a lot of people don't talk about it. So looking at that, not only from a finance property perspective, maximising your borrowing capacity, but also the health ramifications on that as well.
Yes.
And another key point towards the end is looking at how mortgage brokers can find you the best deal to ensure you get the highest amount of good debt for your property as possible. There's also a lot more to cover, and stick around too. At the end, I end up choking on my on something in my throat. So there's a bit of a laugh there for you to maybe take the piss out of me as well. I look like I'm crying.
Guys, enjoy the episode. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jaryd, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Yeah, so borrowing capacity. How do I get as much money as possible, Sam?
Oh,
I nearly said your nickname then.
Oh,
Powell.
Yeah. Oh, well. Hopefully everyone gets to know me in multiple.
You guys can just call him Powell. That's what we've been calling him for the last 20 plus years.
Yeah, that's an old high school nickname that gets stuck.
What do you guys call me?
Krause.
Yeah.
But anyway.
Anyway, so
how to maximise your borrowing capacity?
How do I get super rich, like with as much debt as possible?
Yeah, and don't be fearful of debt, and we'll do it. Well, there's so many episodes to cover here, but yeah, we'll touch on that in the future. But coming in from this is like the foundation series that we're putting together. A really key component of that is how to maximise your borrowing capacity. Obviously, the more money you can borrow, the greater asset you can purchase, and there's obviously strategies around that too. Going to your full borrowing capacity could be okay for some people, but at the same time, there's others that would probably be beneficial of not going to the full borrowing capacity, because that could hinder their, ability to go again sooner in a different asset. And you can diversify your risk into different asset classes, but that's a whole other piece. But here we're trying to talk about how to maximise your borrowing capacity. So jump on in.
Yeah, so I guess we're going to have, and I think we should probably share some stories that you've got, some that I've got, around different ways and examples that I have or other people have increased their borrowing capacity, people that we both know or individually, vice versa. But I guess we start from like the foundational, what are the top few things that we can do to increase our borrowing capacity, Sam?
Yeah, well, stability equals predictability in the bank size. So having that stable income gives confidence to the lenders. So it's not just banks, there's other lending institutions as well.
So what do we mean by stability? Like, what's stability of what?
So consistent income is good,
Okay.
and consistent level of expenses that they can track is good. And there's obviously ways, as I mentioned last episode, banks are looking at your income, your expenses, and your assets to justify your risk profile, and that's going to lead into how much they're going to lend to you as well. So the first thing that I'd probably jump into is, looking at your debt that you've got at the moment. There's three key ways of actually, removing that debt, or making it look prettier, as I say, in the bank's eyes, and that's to either repay it, to cancel it, or to consolidate it. So if we bring into an example, say for one of my loans that I was going for, I had a $8,000 credit card. I had it fully paid off, but it was the structure was still there. What I did, and what I general advice around that is, if you remove that credit card, banks will look at it, even though you've got no money owing on it, they still look at it. Well, they've got access to max out that credit card tomorrow at $8,000, so they look at it as a liability, and they assess that as if you have the full $8,000, for example, owing to them. And what that does is reduces your borrowing capacity by generally 3 to 4x of what that limit is. So
I've heard it can be more as well sometimes.
Different banks. And obviously I'm not a mortgage broker. They'd be more savvy onto that. That was just the advice from my personal situation at that time. And that's massive.
So let's give it numbers, right? Like let's give an example. Because I had one of my examples is like I had a business credit card which was like tens of thousands of dollars in credit, and I had to decrease it. Wanted to decrease it and was told by my broker to decrease it to a lot lower, and only for a 2-week period that the bank was going to assess my situation prior to getting the pre-approval. So you can decrease that limit and then expand it back out based on the lender that I was using at the time. Obviously, it's going to be different to everybody's different circumstances. But say if somebody decreases their credit limit to $10,000, just for simple maths, that means what would their borrowing, like even if you had zero, so let's compare zero credit card to a $10,000 credit card. A $10,000 credit card would reduce your borrowing capacity by 3 to 5 times. So that's what, 30 to 50 grand. Yeah.
And sometimes more as well.
Less. So if you wanted to get a $400K loan and you got a $10K credit card with a 0.5 or x5x, maybe you can only get $350.
Yep. Okay. And that's a really simple way just to cancel the credit card for the 2 weeks. And reapply for the bank, and you have an extra $50,000, which can be a massive difference, because you're going to be increasing the quality of the asset too, from a $350,000 to a $400,000 purchase, and that'll also increase your rental income, because generally you'll get a higher rental income. And
so you typically especially from like $350,000 to $400,000, you could probably buy in a better area as well, right? And that's huge.
So that's the I guess that's that consolidation part. Or remove that if you can, if in your circumstance, obviously reduce it.
Are there any other things in that, like, so that's just credit cards, right? Are there any other ones that are like?
There's a key trick that back in my financial planning days, that it was a very common occurrence. What we would do a balance transfer on credit cards. So that's sort of getting into preparation before going for these loans. But what you can do is do balance transfers. So you might have a credit card with XYZ Bank, and you're paying a 20% interest rate on it, because that's what credit cards generally charge, which is ridiculous. But you've got that 20%, that's actually affecting you paying down that debt. So if you do a balance transfer, other banks will actually entice you into their bank by saying, well, bring that debt over to us and you don't have to pay that interest component for 12, maybe 24 months. And what you're basically doing is using whatever money you're paying that interest in to pay down that principal, which helps you pay down that credit card faster. So that's basically reducing and consolidating that debt. And it's really important. Another way that you can go about that as well is if you've got things like car loans, personal loans, other credit cards, to try and consolidate them into one loan structure that has a lower interest rate.
Nice.
Yeah, so
it's kind of like refinancing multiple loans into one.
Yeah, so I mean, if you've got a car loan, it might have a high interest rate, or a credit card. This is not financial advice at all, but it's just a strategy that can be put forward, and your mortgage broker and accountant, financial planner will be able to assist with that. But basically, you're really looking at the interest rate component of whatever debts that you've got. So you want to try and find the lowest debt possible, because that way it's going to have the lowest amount of, repayments. And with that, you're increasing your net cash flow, and the banks like to have a higher net cash flow. And by net cash flow, I mean what the cash you have on hand at the end of each week, each month. If that makes sense.
Gotcha. So that means decreasing the loan amounts, and then also trying to decrease the interest charged.
Well,
Is that right?
yeah. Well, if you're consolidating, you still have the same debt amount. It's just that you won't have. Well, one, it's a lot more simple because you only have one debt to be repaying, and two, you'll have a lower interest rate component. Those that already hold property, like say it's a principal place residence or another investment property, strategies that have been used in the past are, basically refinancing that loan, because you've got a low interest rate, because property is lower risk. It generally runs at, say, like a 3 to a 7% interest rate, whereas credit cards generally run around a 20% interest rate. What you do is just draw the equity that you have available out of that principal place of residence or other home. Take that 50 grand, pay off your credit card debt, your car loan, all those higher interest rates.
Gotcha.
So you're removing that liability, and then therefore you've got the higher component in your property
PPI,
loan.
Yeah.
But your interest rates, as I said, like say 3 to 7%, and then you're using that spare cash flow. And this is the key.
That's amazing. That's an amazing share. Like just the way I think about it as well is like you've got liabilities. So typically, what you're saying, consolidate or cancel and remove/decrease the bad debt, liability debt versus debt on assets, which is good debt.
Yep. And
you're taking equity out to pay off, say, a car loan and a credit card, just wiping that out, cleaning the slate, and then rolling that into a lower interest rate with just one debt.
Yep.
That's guys, that is massive.
Yeah.
You get Sam just rolls that off the tongue like it's nothing, because he helps people make a lot of money in this game, but that is huge and can tap into that for sure.
Yeah. Well, a lot of financial planners, it's a pretty simple strategy, but as I say to people, you don't know what you don't know, and the world is set up for you. This is my pessimistic view. Is businesses are there to make money from you, and in my eyes, it's there to set you up to fail. So they want you to have those higher interest rates because they're making money off you. It's your job to be smarter than them and find more savvy ways to either repay, cancel, or consolidate your debt, and then transfer those, non-productive debts into productive debts. And that's the whole purpose of, investing, especially in property.
I like it. I like it a lot. But also, I guess we should share an example of somebody that doesn't already have a property that's gaining equity that they could go away and cancel and consolidate loans. I'll give you an example. My sister was going to buy a new car. Well, she did buy a new car, and she was going to get finance for it. I was like, oh yeah, cool. Did you get finance? And she bought it cash, and she bought it with cash. And I was like, great, that's awesome, because that's going to help you so much now with your borrowing capacity, rather than having finance. And she had if you have the cash, buy it, right? Or if you've got a loan, a debt for your car, and you can afford to pay it out, pay that out, or pay out your credit card even if you don't have equity. That's decreasing. That's going to help huge.
Yeah. So a good little example of that was I was having a meeting with a first home buyer back in the day, and they had a HEX debt. so the university debt, and it was roughly around $30,000. So they were umming and ahhing what to do with it, and we looked at it that if you paid out that $30,000 in debt, that it would increase your borrowing capacity by $60,000 to $90,000. So you did.
So that's double. That's like a 2x or 3x.
Yeah. So you looked at that, and this was a few years ago, but based on that, it's like, well, you're losing that initial deposit because you like that cash deposit, but you're gaining so much more in your borrowing capacity. So you'd end up having a higher loan to value ratio. They might pay lenders mortgage insurance on that front, but the lender's mortgage insurance on, say, from a 80% LVR to an 85% LVR is only a few $1,000s. So you
depending on the asset size.
Yeah, depending on the asset size. But you look at that and it's like, well, from a strategy point of view, that made a lot of sense at the time, and they were able to get into the market. They had to pay a little bit of lender's mortgage insurance, which from an, I guess, a principal place of residence, and at that time too, which is 2019 was back in the day. You look at the growth that they've had; they were able to get into the market
at a great time.
At a great time, when it served them quite well. Whereas if they were to try and save up that initial deposit back to an 80% LVR, then they would have missed that growth that we saw in 2019, 2020.
Yeah, huge. It's really when you think about investing in property, it's just like taking your finances and putting them in the best possible position for those finances to make you money rather than you having to work for the money.
Yeah, that's pretty much the philosophy of life, right? Like,
yeah,
make things work for you so you don't have to work for it. Like, some people might think it lazy. Sometimes I feel lazy, but
I think it's smart.
It's just smarter, not harder, right?
Well, you're literally buying yourself options and freedom.
Well, that's the most.
And that's happiness. I think happiness is freedom.
Well, that's what your whole business structure's around is.
Yeah, replacing your replacing having to work for an income, right?
Yeah, because time, as you said multiple times, in buying online businesses, check it out. Time's the most valuable resource. So, you won't be able to get that back, and that's what I'm sort of focused on helping Australians. Get more time back, and so are you. But you're more like worldwide.
Yeah, but the thing is, it's so damn. This is why I love doing this. Is like, selfishly, I'm learning so much from doing these podcasts, but also selfishly helping people replace their income and not have to work and have that freedom. Like, the fulfillment that I get from that selfishly is like massive, and that's why I do what I do. Yes, it helps people, but it's also so beneficial to me and what we're doing here as well.
Yeah.
So maybe
that's a good point. And our whole thesis here is to try and help people. And I'm learning every single day. Still, like, I'm not the oldest person in the room by any means, but I've been doing this for 15 plus years in property, and I'm learning every single day, and I'm trying to empower people to not make the mistakes that I see, every week, basically.
It's just miseducation, and that's what this piece is, right? It's education.
Yeah. So, well, I guess we'll getting back on track on how to maximise your borrowing capacity.
Yeah, so that's consolidating and cancelling liabilities.
Yeah, so debt consolidation and repayment or cancelling them is really key to maximising borrowing capacity, because if you can do either any of those three things with your debt, it's going to enhance your your net cash flow at the end of the day. And there's three key prongs in this. So it's your debt, your income, and your expenses. So step one, reduce your debt wherever you can by cancelling, consolidating, or repaying it. Step two is, let's look at your income, and you're a big proponent on that one.
Make more money.
Yeah. How do you increase your income?
That's right. And so as an employee, you've got so many options to increase your income as well. You can ask for a raise, obviously prove to your employee that you're really good. I like to give my people more money, bonuses, all that sort of stuff. And you can do that as an employee. Another way to do it, I guess, is getting another job. I think I shared this example in the first episode where somebody that came to do work with us and buy business, they wanted to make more money, and they got another job, and they're doing two jobs to save for their them the money to be able to purchase their business. And so you can do that. And then there's other ways, like you can invest in other assets, or like what I teach is buy a business, or make money online somehow. Like I'm not an advocate for starting a business. It's a huge thing. If you were to see what I actually do, is I tell people not to start a business because it's 90% failure rate. But there are ways that you can earn an income online. So say if you wanted a second job, there's ways that you could just work online part-time, or choose your hours to work online for different sort of employers.
Yeah, hustle. I mean, we've all been
hustle. That's it. It's not probably not hustle, but it's I don't know. My take on hustle culture is it's toxic, but yeah, you can work smarter and still do extra hours as well. I mean, you remember when like I was first starting out, like I did the hustle thing, but that's became very toxic for me.
Yeah, long-term hustling is, I guess, toxic to the soul. Which can lead to health inefficiencies, but that's my wife's domain.
Which actually happened to me. Yeah, I got Epstein-Barr virus from overworking. I didn't even realize,
Wow. I got thin hair.
Which is way better than having Epstein-Barr virus.
I guess the thing that came to my mind was I've been in a few like Ubers or cabs in my time, and you see the driver also taking phone calls.
Yeah,
like, are you doubling down, and that's increasing your hourly rate, right? Like,
yeah, that's a really, really good point. Increasing your hourly rate, and that's what you've done in through your line of work, and also like, so you could go the route of like, oh, I'm doing this job as a plumber, what I used to be, and then I'm gonna in my off hours I'm gonna do Uber Eats, right? But as a plumber, I would have been earning more money through plumbing. So I'm actually decreasing my hourly rate. But how can I increase my hourly rate so you're working smarter, not harder, but earning a higher income? And maybe that could be, well, maybe I'll do some overtime, or ask the boss if I could do some overtime because I know I'm going to get time and a half, or
upskill.
work on some, exactly, upskill.
Cut you off there.
No, upskill is a way to go. Is upskill like,
do a little course or something, learn how to get your excavation license or something like that. Like, it's a step backwards because you got to take that time, but then
it's one step backwards though, to get two forwards.
And that's a big part of my life. It's always taking a step back, which at the time is it's difficult, but then you see the compounding effects over time. And for me now, I get excited about taking step backs because I can see what it could lead to. So
increasing your income, upskilling, working online.
Yeah, asking for a raise. There's multiple different ways from that front. But
I'm a big advocate for decreasing your expenses, which we'll talk about in a second. Decreasing entertainment expenses.
Oh, well, let's jump into that now because we covered that income part. But expenses. That's the three-prong approach, and we've covered obviously debt, income, and now this is the simplest way to maximizing your borrowing capacity is looking at your expenses. Yeah,
and what I was just like coming back to, like, I think I'm a big advocate for decreasing your entertainment expenses, but I'm actually a bigger advocate that you're earning more money because you can only get so much wiggle room or play with decreasing your expenses versus increasing your income. There's no limit, like sky's the limit. You can increase your income as much as possible, which will help you increase your borrowing capacity so much more than just decreasing some entertainment expenses. We have talked about decreasing expenses before. We're going to cover it again, but in a different flavor, I guess. So what are some of the ways that you've seen people be able to decrease their expenses?
Go through your discretionary and non-discretionary spending habits, and this is why it's so key in this component of maximizing your borrowing capacity is that banks are looking at all this stuff. So when you're giving your bank statements to them, whether they're 3 to 6 months, they're scanning through and seeing what your habits are. if your habits are consistently Uber Eating every Friday, Saturday, Sunday night, they're going to take that as a consistent expense and amortize that over their calculations, and that'll reduce your borrowing capacity. Same with, I've had clients that they were taking $50 out of the ATM at a local pub every single Friday, and they saw that over their statement. It was consecutive, so
that's like $250 a month or $240 a month.
Yeah, well, so $50, so yeah, 4 to 5 weeks.
So I guess like if you're thinking about like Uber Eats every Friday, Saturday, and Sunday night, and it costs you for you and your partner $50.
Yeah, round numbers.
$50, $150 every week, plus $50 out of the ATM. That's $200 a week. It's about $800 a month. That's all ends up being a decent amount when you might not need that $50 towards alcohol, or you could, make your meal prep like what I do.
Yeah,
but that's
break down further. $800 a month. Okay, cool.
Yeah.
What's that? Like, say you're doing that 10 months a year. It's $8,000 a year.
Yep. That's
it all adds up, right?
Yeah, definitely.
Yeah, even like the classic thing, $20 a week's $1,000 a year. Just thinking of it that way, like multiplying it over an annual basis, you start to see that holy crap, I spent a lot of money on shit. That's just Uber Eats. Banks look at that kind of stuff. They look at your cash withdrawal. So if you can, like when you're prepping to go for a pre-approval loan, you really want to remove all these these expenses out of your bank statement, because they don't want to see that stuff, because banks are going to look at that and say it's consistently going through, and that's going to reduce your overall borrowing capacity. So it could be 3 months or 6 months of pain, but you know what, like put the big rocks in the jar first, right?
Yeah, definitely. And gambling.
Oh, yeah, don't.
I want to get you started on gambling
they
because
hate it.
They hate it, right? Like I remember a couple of years ago, I was surprised. We went to a friend's house and everybody was just putting bets on, and I not really into gambling and like phone gambling, like apps and stuff. And I realized, like I'm a bit of an oddball, right? Like how I live my life. You guys will probably find that out, but I'm pretty structured and like anyway. That's besides the point. I realized that gambling.
Tell me more, Jeff.
I realized that gambling runs so deep in our culture and in our lifestyle in Australia. Like it's so damn common.
Yeah, put the TV on, watch any sporting game. What's the most advertised, platform, like gambling platform?
See, I guess I don't have a TV, so that's
oddball.
Yeah, oddball. That's one. So, yeah, I mean. All you'd have to do is look at how much money is spent in gambling a year in Australia alone, to work out that, if you divided that by how many people are gambling and then how much they're spending. Maybe you guys should look up maybe you guys are listening and you do gambling. Not to say that it's wrong or anything like that. Everybody can do what they love to do with their life.
Well, it's wrong if you're losing. If you suck at gambling, stop gambling, mate. Like, look at your precedents. Past performance is an indication of future performance. So,
so gambling, quit that, right? Obviously,
at least if you're going for a loan.
Especially if you're addicted, and if you are addicted in being all seriousness, like speak to somebody, get help. Reach out to us, and we can recommend somebody.
Yeah, that's a good point.
It's that is fair. Like addiction is a thing. Blow Up the Pokies by the Whitlams is a really good song on his friend that, I think he committed suicide because of gambling. So legit, if gambling is your thing and you need help, reach out to people. But also, for us getting back into property, how do they look at the gambling transactions?
Yeah, well, gambling is addictive, so they don't. They see the transactions. If you're sending money to one of your gambling accounts, then
one of the accounts.
Yeah, I've seen some things. Man.
So people have multiple accounts, right?
Yeah,
and probably multiple apps.
Yeah, well, they all have different, enticements. They're all fighting for your attention, but obviously, them gambling companies are making a lot of money, so maybe they're a bit smarter than Joe Public. But just going on to that thing, like expenses, it's the easiest way to help maximize your borrowing capacity, but just remove those, I guess, discretionary items out of your payments for 3 to 6 months. If you want to maximize, your potential, go through, and then we talk about this in the first episode about budgeting.
Yeah.
Like you can start to see, and it's a really good exercise to do because people just get so caught up in their day-to-day lives, they don't see, well, where is my money going?
Yeah.
And a lot of the time it could be caught up in things that, don't give you that, real satisfaction. And that's why I keep talking about the big rock in the jar. And I mean,
everlasting satisfaction versus short-term satisfaction.
Yeah, that small dopamine hit gets removed, pretty quick. What is it? I thought it was 3 weeks. But some people say when you drive your new car off the lot, then
really?
Then it goes then. But
yeah,
well, the reality comes because you're like, oh, I really want that car, for example, and you're working towards it. You're really stoked you're going to get this car. You've got it on tick, so you got like another $30,000 in debt. But I get to drive around this cool car.
Yeah,
and then you got to. You get the car, you drive out a lot, and you realise, shit, now I've got to pay $200 a week just in interest repayments on this car. And I feel good. That's great. If it's through a company, you might be able to get the tax deductions. There's always strategies around that. But say, like, if you don't own a place that you're either living in or that's growing in value, you've just purchased a liability. It's not an asset. It's depreciating over time.
Yeah.
So that's going to get you further away from your goal of financial freedom.
So in the first episode, we talk about the leaky bucket syndrome and how you can roll those things into an investment account. And just thinking like literally about how much people may spend on gambling, say they're spending $100 a week, so $5,000 a year, roughly, that can really compound a lot. And I dare say people probably spend more than that on average. That could compound a lot into a deposit.
Yep.
And not only is it, so I'd like to think about second and third order consequences, which is basically, in layman's terms, is the compounding effects of you rolling the money that you would invest into, I wouldn't say it's a good investment, but investing into gambling versus rolling that into your account, your investment account. The first order consequences is saving for deposit. The second order consequences is it's helping your borrowing capacity significantly.
Yep. Good point.
And the third order consequences is it's increasing the size of the asset that you can purchase, which is getting you closer to financial independence.
Yeah, you can also make, like, whilst interest rates are reasonably low at the moment, but you can still, if you've got 20 grand and you know that you need to get to 80 grand to get to that purchase, put that 20 grand in a high interest only term deposit or something like that, where you're investing it in a way.
You're putting that money to work for you.
Yeah. That's what I did at the start. And it's not the best return on investment, but the risk
helps.
Well, yeah, if I put 20 grand into the share market and the share market just dropped, then now I've got 15 grand and it's actually got me further away from my goal.
The risk is higher than putting it in a term deposit.
Yeah. So there's different structures as well. I mean, even there's personal loan companies that they basically use your funds to lend out to car loans. That was one strategy that I looked into back in the day, and they were paying a 10% interest rate, and it was the way they structured their business was quite low risk, and that obviously increased my interest rate from that point in time. But different ways of going about it. You really want to just be targeting towards that, say, hypothetical $80,000 that you want to get to, and figuring out the best ways to get to there is going to, I guess, enhance your borrowing capacity, but also enhance your financial position in life. Because once you do go down that asset route and you're going into an appreciating asset and you're using debt, you're fixing that debt in today's dollars, which is going to actually decrease over time because you're obviously paying down the debt, but also the inflation rate and the value of that dollar today is going to be worth less in the future.
And you're securing a property
which is appreciating.
So the debt's depreciating and the assets appreciating.
And that might get a little bit convoluted at the moment, but that's what we're going to. I really want to break that down. Like, there's some really good resources out there that help that. And there's a few good books that we're going to put on the website for you to sort of like look into and understand. Because just listening to the podcast, I mean, like it's one way of introducing it, but then reading literature, if you're into that or not, it definitely helps you get around that thought process. And then, I mean, if you're really not a big fan of reading, that's completely fine. There's audiobooks or there's people to do it for you. So just if you have any questions,
you've got to learn. You've got to learn, guys. And we're just going to refer books that we've read and we know that are great, and get people results. There's 2 books that I always recommend to people, and we'll probably talk about that in another episode, but you could go to our site, propertypals.au, and check that out. We'll have resources, but we've also got like property finance guide on there as well, that you guys that's been created, and you guys can check that out and download that.
Free download, so you can resort back to it step by step.
Before we wrap this up, I wanted to ask you about borrowing capacity. We can do things personally like increasing income, decreasing expenses, and like cancelling and consolidating debt. That's within our control. Is there anything that our brokers can do in fun, structured ways that could allow us to increase our borrowing capacity? Like, is there any things that we could do? We got that control over our own finances prior to going to the broker, but there's certain things that they can do for us after we've extended ourselves as much as we possibly can with the control that we have over our own finances.
And I think what we're going to be doing is getting a couple of different brokers on the channel, just to introduce you to them, but also to ask some really key questions, because they'll be up to date. But look, they go through different aggregators, and they're basically mortgage broking houses, and the relationships that they have with the banks and lenders, like
many lenders,
the business development managers that they work with, they are a really valuable resource, especially the good ones. And what they can do is sort of shop your situation around, and they can help maximize, because different banks and lenders have different terms and conditions, and they're always changing, right? It's actually a really painstaking process to go through, because XYZ bank might have, favourable terms for first homeowners, but then 6 months later they cancel that product.
Yep.
But what they do is they advertise it, they get people in, and then
secure their business, really.
Yeah, and they're always thinking of unique ways to market a certain product. Whether that product stays around long term or not, it's up to the bank. But there's some really interesting things going through the finance lending space at the moment, like the advancement of, I guess, AI and tech, which it's definitely going to help people from that front. So being on the front foot and working with people that do things, in that industry every single day is always a valuable resource. So they can, and it's obviously just case by case basis.
Yeah, definitely going to be based on somebody's personal finances and where they're at.
Yeah, well, there's so many different aspects to it. Like there's people with 2 incomes, 1 income. Sorry.
Yeah, and then also how many kids they may or may not have. Just their own personal finances, and then what assets they have to or don't have, or liabilities that may be best suited to a certain lender.
Yeah. Yep. Yeah, that's completely right. Like everyone's got a different risk tolerance. So.
I guess we wrap that one up. Thanks for listening, guys, and check out the links. We'll put links to books and all the things in the show notes, and then also check out propertypals.au. There's no .com in it, just propertypals.au, and get our finance guide. That's going to be, it's very dense, and in terms of dense, I mean applicable.
Yeah, I mean, it's just a guide, and then any questions. Oh my God, sorry. I got something in my throat.
Yeah, have some water.
Wrap it up.
We'll wrap it up. We'll speak to you on the next one. The next one, we probably, in the future, we're going to get some mortgage brokers on, and we've got a lot more good stuff to come. So, stay tuned, guys.